Welcome again to a new video of Irrational Investors. This time we will talk about the pros and cons of two major capital allocation decisions: dividends versus share buybacks. So, which one is better? Let's find out.
Okay, so let's get right into it. Picture this. A company is doing really well. It's mature, it's profitable, and it's generating more cash than it knows what to do with. It's a great problem to have, right? But it leads to a huge question. What's the best way to get that value back into the hands of the people who own the company, the shareholders?
To figure that out, let's meet our two heavyweights. First up in this corner, we have the old-school champion of shareholder returns, the dividend. For decades, this was the go-to move for any established, profitable company looking to reward its investors. So what exactly is a dividend? Well, it's pretty simple. It's cold, hard cash that the company sends directly to its shareholders. You can think of it like getting a little paycheck every quarter, just for owning a piece of the business. It's a predictable, tangible reward for your investment. Now here's where it gets really interesting. A consistent dividend isn't just about the money, it's a signal. It's a powerful statement to the entire market. A company that commits to a regular dividend is basically shouting from the rooftops, our earnings are so stable, so predictable that we can promise you this cash quarter after quarter. This tends to attract a certain kind of investor, Someone who really values that steady income, which can build a super loyal base. But that commitment can also be a double-edged sword. Once a company starts paying a dividend, the market just expects it to continue, maybe even grow, and if they have to cut it, that is seen as a major red flag, a sign of big trouble, and it can absolutely hammer the stock price. Plus, for you, the investor, that cash is taxed the year you get it, whether you needed the money right then or not.
Okay, so now let's move to our challenger, the share buyback. This is a more modern, more flexible tool for returning capital. It has become incredibly popular over the last few decades as a sort of opportunistic way to boost shareholder value.
A share buyback, or a repurchase, works completely differently from a dividend. Instead of mailing you a check, the company uses its cash to buy its own stock right from the open market. This reduces the total number of shares out there, which means each remaining share, including yours, now represents a slightly bigger slice of the company pie. And this approach has some really powerful advantages, especially when you talk about flexibility and taxes. A company can announce a buyback and then just do it whenever it makes sense, without the rigid promise of a dividend. And for you, the investor, it's a huge tax advantage. You don't pay any tax until you decide to sell your shares. You're in control. And on top of all that, it sends a message that management thinks the best investment in the world is its own stock.
Of course, it's not perfect. Critics argue that buybacks can be used for the wrong reasons. Because they automatically boost metrics like earnings per share or EPS, there's a concern they can be used to just juice the short-term numbers, maybe to help executives hit their bonuses, all while maybe neglecting crucial long-term investments like R&D. But the biggest risk? A company buying back its stock at a really high price, which is basically just destroying shareholder value.
So the crucial point is how they stack up directly against each other. It's time for the showdown. We're going to compare them across three key rounds: flexibility, tax efficiency, and market signaling. In the first round, flexibility, and there is a clear winner here. Dividends are rigid. Once you start that dividend policy, the market will punish you badly if you break it. Buybacks, on the other hand, are incredibly flexible. A company can speed them up, slow them down, or pause them completely with very little backlash. So round one goes to buybacks. Now for round two. What about the impact on an investor's tax bill? With dividends, you get the cash and you get a tax bill. Simple as that. But with a buyback, the value of your shares might go up, but you pay zero taxes until you choose to sell. That control over when you pay taxes makes buybacks way more tax efficient. Round two also goes decisively to buybacks. And for our final round, what message does each action send? Well, this one is more of a draw because they signal totally different things. A dividend screams long-term stability and financial discipline. It's the mark of a healthy, mature company. A buyback, especially when the stock price is low, signals opportunistic confidence. It's management saying, hey, we think our stock is cheap and this is the absolute best use of our cash. The better signal really just depends on the message the company wants to send.
So with the fight over, it's pretty clear there isn't one knockout punch. The winner really just depends on the situation. So let's look at the specific circumstances where one strategy is clearly the better choice.
So when is a dividend the undisputed champion? It's for the established blue chip company. Think of a classic like Coca-Cola. It has rock-solid, predictable cash flows, and it's well past its high-growth days. For companies like these, a dividend is the perfect way to reward those long-term, income-focused investors and signal that enduring financial strength.
And when should a company choose the flexibility of a buyback? Well, this is the tool for a company that sees an opportunity. Take a modern giant like Apple, which does these massive buybacks. When management thinks the market is undervaluing their stock, or they just have a temporary cash surplus, a buyback is the perfect flexible tool for those exact scenarios.
Let's just put all that information together in one simple summary. As this table shows, buybacks win hands down on flexibility and tax impact, giving both the company and the investor more control. But for sending a clear market signal of stability and health, nothing really beats a dividend. Ultimately, that best for category says it all. It's about context. Mature firms lean towards dividends, while firms that want flexibility prefer buybacks.
So, what should you, as the investor, take away from all this? It's not just about picking a side in the debate.
The choice isn't about good versus bad. It's about matching the company's strategy to its specific situation. A young, growing tech company paying a huge dividend would be a massive red flag. Why aren't they reinvesting that cash? And likewise, a mature, stable company that suddenly stops its dividend to do a huge buyback might also be cause for concern. Context is absolutely everything.
Understanding why a company chooses dividends or buybacks gives you this powerful insight into how management is thinking and what they see for the future. It tells you if they see themselves as a stable cash generator or as an undervalued opportunity. So the next time you see a company announce its plan, don't just ask which method they chose, ask why. Because the answer doesn't just tell you about their finances, it tells you who they think they are and who they plan on becoming.
That's all. We hope you enjoy it and see you soon with another video from Irrational Investors. www.irrationalinvestors.com. And remember that this video is for informational purposes only and does not constitute and should not be construed as an offer, invitation, or solicitation to buy or sell any securities, financial instruments, or to participate in any specific strategies. Any investment decision should be based on the investor's independent judgment, financial situation, objectives, investment horizon, and risk tolerance.